Welcome to your review for exam 2. We're going through chapter 12, but with chapter 12, there's just those basic things on a bond. We'll get into the math of the current yield, yield to call, yield to maturity, taxable equivalent yield calculations later, but you do need to know what a bond is and some of the basic things on that indenture. Okay, so what to expect? Pretty much like you had last exam. 14 short answer questions. One of those you can prepare for. You read any Barron's article of your choice that's interesting to you. Try not to do the same thing somebody else in the class is doing. I haven't had too much of an issue with that. It's okay if some people do the same thing, but if the entire class turns in the same exact article, I'll just give no credit for that because you need to pick one that you're interested in, your own specific thing. I want you all reading an article, not one person coming up with something. So that one you can prepare ahead of time. You give me the title of the article, summarize it, and critique it, apply it to some sort of investment, financial planning, whatever scenario, something you might use that knowledge to help a client. For calculations, you'll probably see some more time value of money, maybe some Alpha Trainer Sharp. We don't have the bond calculations yet, so maybe expected return, maybe that geometric return that you might see on the CFP exam, value weighted, average weighted that we've talked about. And then 5 multiple choice. Do you want me to skip towards the more recent chapters? Yes.
Sorry, I didn't mean to interrupt, but will we have the same formula sheet that we had on the last exam?
I might add more to it, but you'll have the formula sheet. Third exam, I won't give you the specific formula sheet that I've been giving y'all. I will give third and fourth exam. I will give you the formula sheet that the CFP board gives you. So it's not going to have anything labeled, and it's going to have more formulas than you need.
Yeah.
I don't think I used all the formulas on the CFP exam that they gave me.
Hey, is this exam review, is it under your Blackboard?
It should be. You have it? Are you in slides? Are you in exam reviews? Oh, that's just the exam one review. I posted it somewhere. Maybe I posted it in counseling.
We could have seen this one.
But the exam 1 review will have everything except the 9, 10, 11, 12 chapters. All right, so let's talk about our chapter 8. Was chapter 7 on the last one, or do I need to go? Yeah, we talked about those guys, right? In the last exam.
Yes. Yeah. I think so.
Yeah.
It started with stocks and dividends.
All right, so let's start here, and then I will go back to other things. So most of your stock that you and your clients are going to have is going to be common stock. Most stock is going to be held in a mutual fund, so you're not buying it directly. The Fidelity, the Vanguard, the Schwab, the TIAA-CREF, they own stock. Most of the market lives in mutual funds, and more specifically in retirement funds. So these common shares of stock, if you do own them directly, you get that vote. I own in their success, I own in their failure. If they do well, I do well. I can't tell them what to do with their dollars, how to run their business, anything like that. But I could go to the shareholders meeting that's held once a year, and I can give my opinion on whatever I want to give it on. So common stock is what you're mostly getting, and you're going to see the price of that as the market price. We saw that random walk where things change by a few pennies or a few dollars in a day. And we have preferred stock. Preferred stock, now I may be able to demand that I receive a dividend. if my dividend wasn't paid in the first quarter, I can demand that they accumulate what it should have been and then give it all to me in quarter 2 or quarter 3, whenever I'm gonna get that. With the common stock, dividends can come or not. I have no say in that. What power I might have is the ability to vote for the board of directors. So each share gives me a vote. I might be able to have cumulative voting where all 5 of my shares, my 5 votes, I can put towards one of the 10 seats on the board, or however many there are. Again, because mutual funds own most of those individual stocks, their votes are the ones that matter. If you want to have your vote drive a company, you need to own a significant share of a company. So you might see that with some smaller companies where some investor with lots of money has invested heavily in it, and then they get to basically place who they want on the board because they have enough votes to do so. So common versus preferred. Preferred's going to be more expensive because it's a little bit less risky. With those dividends, remember our mutual funds are flow-through entities. So Vanguard, Schwab, they're going to say this mutual fund has a performance of, over the last 5 years, we had an 8% rate of return. Over the last 10 years, whatever percent rate of return. What you actually receive is going to be less. So the net that you take home, because they're telling you this after tax, before taxes, before fees, before anything is added on to it. So they don't know where you're holding that. It could be they have this S&P 500 index fund, so passively managed, low fees, but all those taxes are passed on to you. And if you hold it in a tax advantaged account, the Roth, the traditional, your 401k, doesn't matter until you actually start taking dollars out. But in your taxable account, then you've got capital gains. Our capital gains can be short-term or long-term. Let's say they're always going to be long-term for our clients because we're not trying to sell before a year. As long as we hold it for at least a year, we get long-term capital gains. Those are going to be 0, 15, or 20%. For most people, it's going to be 15%. This is based on our income. Short-term capital gain would be taxed at ordinary income rates. Dividends are almost always going to be long-term capital gains, unless it is not a U.S. company or I just bought it. They're going to count as long-term capital gains, and it doesn't take long for dividends to count as long-term capital gains. We saw our payout ratio and our earnings ratio, retention ratio with the dividends. So payout and retention combined equal 100%. So you can figure out either one by saying one minus the other. So all we need to know is one. They have to add up to 100. So all the earnings they had, they're either retaining or they're paying out in dividends. And when they say retaining, that could be paying off debt, buying new inventory, hiring people. Yes, James?
My bad. I was just going to ask, with regards to voting rights, I didn't mean to.
No, go ahead.
What is the difference between like common and preferred stock for voting rights? I'm sorry, I know you kind of just.
You'll have the same vote.
Okay.
You could potentially have some preferred stock that doesn't let you vote.
Okay.
But for the most part, your votes are going to be equal. The advantage of the preferred is that I get to demand I get my dividends if that's built into my contract.
Either could be like both tend to be either statutory or cumulative. There's no
So what do you mean statutory?
like I guess
That I can't do it cumulative, that I can't combine them all? Most of them tend to be that way, yes. Where I've got one vote for every share and I can't bring them together.
okay. Thank you.
And the bylaws would let me know what I can do with that.
Gotcha. Yes, sir.
Dividends can be paid out different ways. Here's some dollars, and I'm taxed on that. If it's paid out in stock, just like we talked about with our paper profits, there is no taxable event until I actually sell this. So if instead of giving me $1 in dividends, they give me a percentage of a stock share, and that's now something I own, until I sell it, there's no taxable event. A stock split, and we talked about how this could go both ways, where my one stock becomes 20 shares, or my 20 shares become 5 shares. So we can take a bunch of stock and bring it into fewer. And the reason you'd want to do that is maybe your value has gone down. And so now you're trading at $1 or $2 per share. So I want to combine those so that now I've got $20 a share. And now I can get listed on the New York Stock Exchange again because I was before too low. The other way, we might want to say, okay, now our shares, excuse me. No, thank you. Our shares are $1,000 a piece, and it's harder for people to get into that. So I want to split them into 250 a piece. So every one becomes 4. It's not going to change the individual investor's position. I have the same $1,000 worth of this company. It's just now 4 shares instead of 1 share, or 1 share instead of 20 shares, however we split it up. So no taxable event there. It's just I have more or less in number of shares, but my actual dollar amount is the same. The DRIP is that dividend reinvestment plan, where that's through the company and that can save me some dollars. Within my own brokerage account, whatever type of account I've got, I can usually just check a box, whether it's one of those tax advantaged, and say reinvest all dividends into the same company. Or what I do is I say, instead of reinvesting those dividends, put it in a money market, and then I'll decide where to invest it every quarter or so. We went into Edgar. Edgar, every publicly traded company is filing their annual, quarterly, still quarterly for now. That may change to twice a year, but they're filing their reports, and the annual report, the 10K, is going to be audited by some external accountant firm, usually one of those big 4. Those firms are going to verify that the numbers are good, or they're going to put a note on there saying, I don't agree with these for like whatever reason. So there can be different notes within that 10K that's filed. The quarterly reports, they don't have an outside auditor. They tend to agree with our annual report. Other reports on there let you know when the CFO, somebody like that, buys or sells shares in the company. Give you an idea of what's going on. With that 10K, we were able to look at a company and divide it into groups, and each calculated one of these. For the exam, I would want you to know all 5 of these and what they do and who would be interested in each. So why is this useful information? Liquidity, how much cash do they have? How quickly could they get their hands on cash? So we had our current and quick ratio there. Activity, how fast do things flow through the firm? And depending on what type of company it is, we're more interested in different things flowing through the firm. Profitability, if I'm an investor, I want to know if this company is making money. I've got my gross, I've got my operating, I've got my net, and they would go in that order. Gross should be the largest, and then here's my operating expenses, and then here's what I get to take home. So gross, operating, net in that order. Leverage, how much debt do I have? And not necessarily a bad thing. That's one of those things that you can diversify, business and financial, when we talk about diversification, unlike our primes that we're just accepting as part of the risk that we take on by trying to make money. And then finally, coverage, can I pay off my debts? So if I'm a lender, I'm interested in, do they have the coverage to pay off their existing debt? If I lend them an additional $1 million, would they still be able to pay me back? And if they're riskier, I'm charging them a higher interest rate, or I'm just not going to lend them money, or not the full $1 million. Maybe I'll say, well, I'll lend you $500,000, but not $1 million. Oops, sorry. Chapter 9, because a lot of this is not going to, a lot of that math in there was not going to help you create a better portfolio. I want you to understand that it exists, but I want you to leave the class being able to create a diversified portfolio and know what it is you need to do that for a client. Some of this stuff we don't need, so here, understand what that fundamental analysis is, discounted cash flows, bring in what we think is going to happen back to today. I don't have a crystal ball, so my guess is as good as yours as far as what's going to happen in the future. Analysis of financial statements, that's where we're going into Edgar, calculating those different ratios and figuring out what shape this company is in right now. We saw Rigetti that we looked at with their 10K from March. It looked like they were just burning through money. But then when we looked at, I want to say it was last month's quarterly report, where it had drastically changed. Their financial situation was much better more recently. So take into account the idea that the 10K may not be timely. If it was filed yesterday and you're working on it, yeah, absolutely, that's great. You've got some current information. But if it's 9 months old, then it may not paint the same picture as what it is right now. And if it's a company that's been established and nothing has changed in the legislation, nothing has changed with them creating some new Ozempic, something that's going to massively change how they're operating and what money they're making, then I could look back at like the past 5 years and see, okay, they have this steady trend of doing these things. Then I might have more confidence in that 8-month-old 10K. But I would still want to look at some quarterly reports. I would still want to look at things that give me a more current perspective of whatever the company's doing. Our efficient market hypothesis, we had our weak, semi-strong, and strong, where in a strong form, even with inside information, we could not beat the market. With the semi-strong, with inside information, I could. And semi-strong is what we see in most developed countries. If you have inside information, you can consistently beat the market. And we see that with our congressmen and women that have much better returns than the average people. They consistently beat the market while they're in office because they have inside information on legislation changing and, Operation Warp Speed, dollars going to different companies. Different ways that we can look at our portfolios. Price weighted, kind of weak because it doesn't take into account that I might have a bunch of shares of one and only one share of the other. So think of this as both for your portfolio and for the market. So we saw the S&P 500 that is going to be more value weighted. If Google were to suddenly be half the value, like they lost all their money in a lawsuit or were forced by legislation to divvy up stuff and become multiple companies, that would change where they are on the S&P 500 because it looks at by market capitalization. Market capitalization is looking at all of their dollars, so value weighted. Google's a huge company. It's going to be up there towards the top of the S&P 500. If we go down towards the bottom 20 of the S&P 500, those companies are not as large and they're not going to move the market as much. Right now, we've got the top 10 or so companies in the S&P 500 being in tech. So when tech does well, that's going to shift the entire index to look like it's doing well, even if individual companies that are lower down aren't doing as well. Geometric average, we saw how we could do on our calculator, whether you had the Texas Instruments BA2 Plus or the HP 10B2. The different indexes, Dow Jones Industrial Average is going to be price weighted, where the S&P 500 is value weighted. We saw different indexes that were looking even at active areas, but they consist of an index. When we invest in index, that's passive investing. You're following it and you're paying the lowest fees. A mix of those is what's usually used in those target date funds, where the actively traded funds are going to cost you more in fees, but they're using that money to pay the experts in that field that are deciding what to buy and sell. With an index, there's no thought process into what to buy and sell. It's just, that's what's in the index. I'm trying to mimic it, the index. Let's try to buy those shares and sell when this one goes down or up or whatever they're going to do so that it matches what the S&P 500 has. Dollar cost averaging, I gave an example of where most people do this. Do you remember what that was, Jewel? Where would a client put the same dollars into an investment every pay period? In your retirement accounts. So when you say I'm putting 15% aside for retirement, or your clients are putting 15% aside, 15% of their paycheck is going to this same investment mix. Unless we've changed it, but we're dollar cost averaging, we're putting the same dollars into the S&P 500, into Rigetti, into whatever the different things that we've got in our account. And what this does is, markets are up, I'm buying fewer shares. Markets are down, I'm buying more shares of the same thing, because I'm putting the same, say, $1,000 in every month. That is going to buy more shares if the market's down. So I'm putting the same amount. Averaging down, when I think the market is down, I buy more shares then. Hard to time the market. This one is going to be tougher to do, where the dollar cost averaging is more the set it and forget it, which is, for the most part, the way that we're going to overcome those behavioral finance things that we talked about. Yes.
Is there like formulas for price weighted versus value weighted in the same way? Like, didn't geometric average have like a formula? Sorry.
Yeah, so those formulas are in the slides for the chapter.
Okay.
Price weighted A plus B plus C divided by 3
Okay.
would be the formula.
Okay, and value just has like these.
And then we're multiplying by the number of shares. If a share is $1,000 and I've got 20 shares, 20 times 1,000 is 20,000.
Okay, I got it. Thank you.
Yep. Macroeconomic environment. So we're looking at the big picture. And with all of these, look at the big picture, and then we're drilling down more and more into the specific investment I'm trying to get into. So macroeconomic environment, we gave examples of if legislation changes, how might that change how you invest or how you invest on your client's behalf? If something becomes legal, fracking, if something is going to have tariffs on it. So the soybeans in the US, where the big purchaser was China, but now China found alternate sources. So there's going to be a lot of soybeans in the US. Price of soybeans would go down. Gross domestic product, that is all the stuff in the US. We use it as a measure of sort of economic health. And we've got e-cig there, which is our exports, our consumer expenditures, investments by consumers, and then government spending. So all of those combined into gross domestic product. And you'll need to know each of those elements. CPI, along with CPI, Consumer Price Index, that basket of goods. We also looked at some consumer sentiment things, where what do people think will happen in the next 6 months, in the next year? How do they feel about where they are financially today compared to 6 months ago, compared to last year? Are they buying durable goods? Are businesses buying building, or are they being issued building permits because they've applied for them? Are they putting in more manufacturing hours? Are people filing for unemployment? So looking at all of those. Speaking of unemployment, one of the goals of the Fed. So the idea is they want a strong economy. So they've got these 3 goals to hit that strong economy. Stable prices. So if I go to the grocery store next month, it's not more expensive than it was this month, and it's not massively more expensive than it was a year ago. They kind of target 2 to 3% inflation rate, and we'll talk about their tools to reach these goals in a second. But they want stable prices. They don't want crazy high inflation. They don't want us to have deflation. Full employment, meaning that everybody that wants a job can get a job. And economic growth. Are we producing more things, making more widgets, all those cool things. Tools of the Fed look at monetary and fiscal policy. The biggest one is that under monetary policy, open market operations, the buying and selling of bonds. With these tools, if I want to cool down the economy, I'm trying to take dollars out of your hand. I want to contract it. And if I want to stimulate the economy, I'm trying to put dollars into the consumer's hands. So every move, think about where the dollars are going. If it's going into the hands of the people or if it's going to the government. Whichever one it is, like that's where the goal would. So they would tie up everything that would put cash in your hands and try to keep it in their hands or take it from your hands. They're trying to cool down the economy. They're trying to keep inflation from going too high. So open market operations, the buying and selling of bonds, biggest one. They can set the reserve rate of how much cash that a bank needs to keep on hand relative to their depositors' deposits. The discount rate is what the Federal Reserve charges banks to borrow from them, and then the poorly named Fed funds rate is what they influence with that. That's what banks charge each other to lend to each other. So if I'm Wells Fargo and Bank of America wants to borrow money from me, I lend to them on the Fed funds rate. So monetary policy versus fiscal policy. Fiscal policy, I'm the government now, and I'm going to raise taxes. I'm going to lower taxes. I'm going to give you a stimulus check. I'm going to spend on the national park system or on infrastructure, something that puts money out into your hands. Or I'm not going to do those repairs. I'm not going to fund stuff if I'm trying to contract the economy. Debt, so talking about deficit spending, we pretty much always do that, meaning the government spends more money than it brings in. So monetary, fiscal policy, you'll need to know both. You'll need to know the elements of each, know that the open market operations is the biggest one, and be able to tell me what each of those is doing. So if I'm putting more money into people's hands, that means that you've got more dollars. It's easier for a business to get out a loan. It costs them less to do so. So I'm going to expect greater returns on those investments because we all have easier access to cash. I'm going to be, if I'm a company, applying for more building permits because I was able to borrow those dollars. I'm able to hire more workers. More people have dollars in their hands. So the lower the interest rate, the easier for everybody to get their hands on these dollars is to boost the economy. Behavioral finance. Investing is not just the dollars and cents. We see that in financial counseling with our snowball and avalanche methods of paying off debt. With investing, the solution that you have for all of these kind of big picture is we created this diversified portfolio that meets your financial risk tolerance, risk capacity, your time horizons, your goals, all these together. We made that plan, and I'm going to rebalance at least once a year to make sure that that's still correct. And I'm rebalancing because if I take on greater risk, I expect greater return. So we expect that my 70-30, 70 into equity, 30 into bonds, and that's very big picture. We could go more granular into that. But that 70% in equity should have a higher rate of return. So by the end of the year, my 70-30 maybe became 75-25. So I'm going to sell 5% of that growth and put it into bonds so that I maintain my 70-30 and steadily grow this to meet their financial goals with that diversified portfolio. So y'all did presentations on 4 of these, really 5, because overconfidence and the illusion of knowledge was kind of combined into one by y'all. Check the discussion board. Every group should have posted their overview of what they covered, and I will expect you to be able to explain 2 of those. So you can do your own groups, you're halfway there, plus one of the others. making sure you paid attention to what was going on that day. Yes.
Is illusion of knowledge like referring to tendency to like give yourself credit?
That's more overconfidence.
Okay.
So overconfidence, I'm so smart, I'm so special, everything that made money was because I'm so smart and special, and if it lost, that was just bad luck. It wasn't me, I did all the right things.
Is it more so just the fact that like the resources that you see you think are like particularly relevant, even though there's like unlimited? Is that?
So you're competing against experts. So illusion of knowledge, I've got access to Edgar, I've got access to Google Finance, there's Barron's, there's Motley Fool, there's all these different organizations that are pumping out. I mean, part of it, like you think 24-hour anything, they have to make a story about something. I'll look at an ESPN something on Sports Center, and they're talking about a specific statistic of, I don't know, assists in the third quarter at a game in the northern region. So like just like ridiculous statistics that mean nothing rather than kind of big picture stuff. So they're just forcing out all this knowledge. Same for the financial markets. You've got Dave Ramsey. You've got that guy that yells and just says like, buy this, sell that. It's terrible, Kramer. All that information is out there. But that gives you the illusion of I've got all the information I need to make this. And yeah, the information is there. But are you using the right information? Are you analyzing it correctly? Do you have a crystal ball? Probably not. With the numbers in Edgar, we talked about how those ratios, they could use different numbers reasonably, correctly, and come up with different answers. So do I include goodwill? Do I think the goodwill of this company should be more or less? And I can put that in my calculation. And if I try to compare it to somebody else's calculation, I may not be looking at the same thing. So I want apples to apples. So all that information is there, but most investors don't have the same level of sophistication, education, experience that the experts at Fidelity have to create this mutual fund. They're sending experts out to the floor of the manufacturing facility. They have degrees upon degrees in specifically chemistry or oil and gas, plus their CFAs and all these different things where we're competing against that. But luckily, all that information is pretty much immediately reflected in the price of whatever the asset is. So index funds are great, mutual funds are great. That illusion of knowledge leads us to try to do more individual stock investing, which fine on the small scale, but bigger, I would go with mutual funds. I mean, that's where the illusion of knowledge comes in. Questions on any of these other ones?
You said just to be able to explain them.
Explain and apply two of them. So it could be the one you did with your group, meaning you're halfway there because that's what you did for your presentation. You explained what it was, you applied it, you gave examples, and you asked questions of the other groups to make sure they were paying attention. So you know your one for sure, and then the second one, any of the others, and they should all be on the discussion board. Common features of bonds. So that's how we kind of ended the class with here's how they work, but not getting into the math yet. So I'll save the math for exam 3 on bonds, but you need to understand what a bond is. A bond is you lending money to either the government or a corporation. And I say the government, a government. On the bond, you have this indenture. So the indenture is that legal contract that's going to spell out this is what you're paying for the bond. So our face value is the par value, and they're going, well, I may pay a discount or a premium because I'm going to get some coupon payments. So I'm going to pay something for it. There's the price I'm paying, and we'll calculate what price we should be willing to pay based on what we're getting for it. So face value, this is what I'll receive at maturity. If this is a zero coupon bond, I'm getting $1,000 in 5 years, I'm definitely buying it at a discount because I'm not gonna just give them $1,000 to hold for 5 years. I'd rather invest that on my own. The coupon rate is how much they're paying me. Could be a zero coupon bond, could be 5%, could be 10%, whatever it is that they're gonna pay me. Are they gonna pay me once a year, twice a year? All that's gonna be on the indenture. So maturity date, I know when it matures. I know how much they're going to pay me while I'm holding it, and I know what they're going to pay me when it matures. I know who issued it, and other things I might want to know about it. If there is a call provision there, so right here, there's probably going to be a call penalty. Most bonds are not going to have the call feature. And if they do have the call feature, that company is going to do whatever it can to not exercise it because they have to pay a call penalty on top of that face value that they're going to pay me. They are going to try to go into the open market first and buy up that existing debt. They do this because it's cheaper to get debt now. They're going to say, well, why pay 6% when I can pay 4%? So I'm going to buy up all that 6% debt that I can without exercising the call penalty and maybe get some of this 4% and then maybe go back in the open market with some more dollars. So I might go multiple times in the open market before I even try to exercise the call penalty, the call provision that forces them to sell. So the call provision, if it exists, means that I must sell my bond back to them when they say. If they do this, they're probably paying that call penalty. It's probably great for me because I got my face value back sooner. I got whatever coupon payments, plus I got the call penalty. So it's good for me if they do exercise it, and I'm gonna know going in that that's a possibility. I can always go on the open market and I can sell my bond somewhere to somebody who's willing to buy it. And just like with any other investment, there's a risk. If interest rates have changed and they can lend money at a higher rate, why would they buy my bond? And if that's the case, if rates have gone up, this company is definitely not going to exercise the call feature. Other things, the market price, I always know what they're going to pay for it. I don't get to negotiate that. It's, what is the market willing to bear? I just choose whether it's worth it to me or not. The yield is how much basically my return. What am I going to receive for this bond? The taxable equivalent yield, we take into account the idea that some government bonds were not paying some of the taxes on it. So if I or my client have a very high tax rate, that government bond is more advantageous to me than somebody with a lower tax rate. If I live in Texas, it's not as advantageous than someone who lives in Alabama, because Texas doesn't have a state tax. So we'll get into that math on the next exam. Credit ratings, we had a couple of different places that are going to basically tell you if this is a high quality bond that is going to almost definitely be able to make its coupon payment and face value, or if it's a lower rated one. And I talked in class about the spread between the two. If it's very narrow between the riskier one and the highly rated one, we've got a bull market, we're doing great, nobody's worried too much about the economy. Even this risky company is going to be able to make enough money to pay me back. The greater that spread, the more volatile we see the economy. All right, so let's go back to any of the previous chapters. You let me know what you want to talk about. Chapter 1. Chapter 2. Okay, so chapter 2, we're getting into the market. We want to make some money. So how are we buying? If we go long, we think the market's going up. We're in a bull market. If we're shorting something, we think it's going to go down. We think we're in a bear market. And it may not even be the entire market. It could be that specific company that I think is going down or up. So GameStop is the big example that's very recent, where a hedge fund company, and I think we'll talk about those in another one. So hedge funds and private equity firms, they do more risky stuff, and you have to qualify to invest with them. You have to show that you've got 10 million in investable assets, and you can put in 5 million now, and if they call in the next 6 months, you can come up with another million within a week. So they want you to have lots of money and be very liquid in order to qualify. They don't have to share their information the same way that those publicly traded companies do. They don't have that EDGAR filing. They are moving in probably something very specific and risky. My orders, I can say I want to buy 10 shares of this company at market price. Cool, that's going to go through very quickly. Or I could do something called a limit order, where I say I want to buy it, but only if this company is selling for less than $20 a share. If it trades at $22 a share, $20.02, my order won't go through. So I put however I want it to buy. If it goes at market price, it jumped up, cool, that's when I'm buying it. I'm getting it whatever the share per price is for however many shares I said to buy. If I do that limit, and that could be for buying or selling, I can say I don't want to sell it unless it's at least this much. So opposite things. I don't want to buy it unless it's this cheap. I don't want to sell it unless it's at least this expensive. So if I say I limit this sale, if it drops below $20, I'm not selling. If I say I want to buy it, if it's below $20, then I'm buying. So it's limiting you on what you're going to pay for it or what you'll sell it for. And I can have that last for the day. I could set that to be for 60 days. I could say keep it going until I cancel it. So it could be running for 3 years. At that point, I probably would have canceled and done something else. Margin account, that allows us to risk money that's not ours, but we're paying interest on that money. So we looked at our 50 and 25% is the magic numbers. Vanguard is going to charge interest on the dollars I borrow, but now I've doubled my investment. So I can say I want to have this margin account that buys into whatever this company is, and now my $100,000 is $200,000 worth. They are fronting me that other $100,000, and I'm paying interest on it while I've got it. But if it makes money, awesome. So I'm magnifying my risk of gain or lost. All right, we're out of time. Any last questions? All right, roll tide.